On the surface, Russia's economy looks like it's holding together. The ruble hasn't collapsed. The banking system is still functioning. Government spending is flowing. But that stability is being held in place with extraordinary effort and at a cost that keeps rising. Every month, Moscow has to spend more money just to maintain the same level of economic stability. Not to grow, not to improve living standards, just to prevent things from getting worse. And that creates a dangerous problem. Because when an economy needs increasing amounts of support simply to stand still, it's no longer being stabilized, it's being strained. In this video, we're going to break down how Russia is holding its economy together, why the price of doing so is becoming harder to sustain, and what this trade-off means for the country's financial future. This isn't about sudden collapse. It's about how long a system can hold when the cost of holding it together keeps climbing. To understand why Russia's economy looks stable on the surface, you have to look at what's stabilizing. The first mechanism is state spending. Since the war began, the Russian government has dramatically increased spending, not just on defense, but on wages, subsidies, pensions, and regional support. This money keeps factories running, keeps households spending, and keeps unemployment low. But this isn't organic growth. It's a demand created by the state. When the government becomes the primary engine of economic activity, stability depends on how long that spending can continue and how it's funded. Which brings us to the second mechanism, oil and gas revenues. Energy exports still bring in large amounts of cash, even under sanctions. That revenue allows Moscow to finance deficits, support the ruble, and absorb rising costs. But those revenues are no longer as flexible as they used to be. Russia is selling more oil at discounted prices, paying higher transport and insurance costs, and facing tighter payment channels. So while money is still coming in, the margin for error is shrinking. The third mechanism is financial controls. Capital controls limit how much money can leave the country. Exporters are required to convert foreign earnings into rubles. Interest rates are adjusted aggressively to defend the currency and manage inflation. These tools work in the short term. They reduce volatility. They prevent panic. They smooth over shocks. But they also distort normal economic behavior. Businesses delay investment. Households hold back spending. Banks become more dependent on the state. And the economy becomes less responsive to market signals. What you end up with is a system that looks stable, but only because it's being actively held in place. And the longer that support continues, the more expensive it becomes, financially, structurally, and politically. In the next section, we'll look at the numbers behind this stability and why the cost keeps rising even when nothing appears to be breaking. When you look at the numbers behind Russia's economic stability, a clear pattern starts to emerge. Government spending has risen sharply over the past 2 years, especially in areas tied to defense, security, and state-supported industries. Monthly budget outlays are now significantly higher than they were before the war, and deficits have become a regular feature rather than an exception. To cover that gap, Moscow relies on 3 main sources: energy revenue, domestic borrowing, and reserve management. But each of these comes with a cost. Energy revenues still matter, but they're less efficient than they used to be. Russia is selling more oil at discounted prices, while paying higher logistics, insurance, and financing costs. That means more volume is required just to generate the same budget impact as before. At the same time, domestic borrowing is expanding. The government increasingly issues debt that's absorbed by state-linked banks, pension funds, and financial institutions. This keeps the system functioning, but it also ties the financial sector more closely to government balance sheets. In effect, risk is being concentrated, not eliminated. Then there's the cost of defending the currency. Interest rates are adjusted aggressively to stabilize the ruble, and export conversion requirements are enforced to maintain foreign exchange inflows. These measures support the currency, but they raise borrowing costs for businesses and households. So even as the ruble holds, credit becomes more expensive and investment decisions get delayed. That's the trade-off. Stability today comes at the expense of flexibility tomorrow. And this pressure shows up in 3 key areas. First, growth quality. Economic activity continues, but it's increasingly driven by government contracts and war-related demand. That supports short-term output, but it does less to improve productivity, innovation, or long-term competitiveness. Second, policy distortion. When stability depends on constant intervention, policy options narrow. Every shock requires a response. Every adjustment has side effects, and reversing course becomes harder without triggering disruption. Third, risk sensitivity. A system that relies on tight controls and continuous spending becomes more vulnerable to external changes, oil prices, shipping routes, sanction enforcement, or unexpected fiscal demands. None of this means the system is about to break, but it does mean the margin for error is shrinking. The economy isn't collapsing. It's being quietly drained by rising costs, limited options, and the growing price of holding things together. And that leads to the most important question, not whether Russia can maintain stability this year, but how long can I afford to pay more each month just to stay in the same place? That's the question we'll close on. What makes this situation particularly difficult is that there's no clean exit. If Russia reduces spending too quickly, the artificial support holding demand together weakens. Factories tied to state contracts slow down. Regional budgets tighten. Employment pressure rises. The appearance of stability starts to fray. But if spending continues at the current pace, the long-term costs keep compounding. Higher interest rates suppress private investment. Banks become more exposed to government debt. Capital stays cautious. And future growth becomes harder to generate without even larger interventions. This is the trap. Short-term stability depends on policies that quietly undermine long-term flexibility. And over time, that trade-off changes how the economy behaves. Instead of responding to market signals, it responds to directives. Instead of reallocating resources efficiently, it preserves existing structures. Instead of absorbing shocks naturally, it requires constant adjustment. That doesn't cause an immediate crisis. It causes fatigue. Economic systems don't just break when money runs out. They break when options run out. When every policy choice leads to another trade-off. When every solution creates a new dependency. When stability becomes something that must be actively defended month after month. This is why Russia's economy can look stable even as pressure builds underneath. The ruble can hold. Spending can continue. The system can function. But each month, the cost of doing so increases, not just in money, but in lost alternatives. And that's what makes this moment different from past cycles. This isn't about waiting for a collapse. It's about watching an economy slowly trade resilience for control. And the longer that trade continues, the harder it becomes to reverse, no matter how much money is spent. That's the real story behind Russia's stable economy. Not what's breaking, but what's being quietly drained. If you want to understand how modern economies manage pressure, not through collapse, but through cost, control, and trade-offs, this is exactly what this channel is about. Because the most important economic shifts don't happen suddenly. They happen slowly, while everything still looks fine.